Chaos is constant in the world of money. Markets rise, markets fall. But once upon a time, a man dared to ask a dangerous question. What if investing weren't gambling? What if it could be rational? His name was Benjamin Graham, and his answer would change everything. Not just for Wall Street, but for the entire world, thinking about wealth, risk, and human behavior. This is the story of the man who laid the foundations of rational investing. Before algorithms, before index funds, before the illusion of quick profits, there was Graham. A quiet professor in his modest office at Columbia University who believed the market was not a mystery to be worshipped, but a puzzle to be solved. While others chased the noise, Graham listened to the silence. His data, his discipline, his logic, and his self-confidence. He wasn't selling dreams, he was building frameworks. And from that framework, a revolution was born. A revolution that would shape Warren Buffett, Charlie Munger, and nearly every serious investor who followed. But it all began with a single truth. Most people don't invest. They speculate, they chase rising prices, not intrinsic value. They confuse activity with intelligence, movement with progress. They are seduced by excitement, the very emotion Graham had learned to fear. And so he wrote, "An investment transaction is one that, after thorough analysis, promises safety of principal and a satisfactory return. Transactions that fail to meet these requirements are speculative." This sentence was the opening line of Security Analysis, a declaration of war. A war against illusion, against emotion, against the tendency to believe that wealth can be created by wishful thinking. The 1930s were filled with chaos. The Great Depression had disrupted the spirit of the market. Investors and business owners had lost everything, not just their fortunes, but their faith. Banks collapsed, businesses vanished, and Wall Street was seen as a casino where only the ruthless survive. But Graham saw an opportunity in the ashes. He asked, what if we stopped predicting the future and started evaluating the present? What if every stock, no matter how chaotic its price, had an intrinsic value buried beneath the noise? This question became the seed of a new philosophy. Value investing, not emotional investing, not hopeful investing, but rational investing, where numbers, discipline, and patience become weapons of clarity in a world ruled by greed. For Graham, the market was not a god to be obeyed, but a frenzied partner to be understood. He personified the market as Mr. Market, a character who woke up each day with a new mood, sometimes excited, sometimes depressed, but always irrational. Graham taught his students, Mr. Market is not to be argued with, he is to be exploited. If he's too optimistic, sell him. If he's too pessimistic, buy him. But never let your mood rule your mind. Because investing, at its core, wasn't about predicting tomorrow, it was about staying sane today. This idea of staying sane is what distinguishes investors from gamblers. Gamblers want noise. Investors want silence. Gamblers want excitement. Investors want patience. Graham's philosophy was never glamorous. It didn't promise overnight riches, but it did promise something far rarer, lasting wealth. It was based on truth, logic, and the courage to ignore the crowd. He used to say, "You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are correct." And that single sentence defined an entire generation of rational thinkers, from Buffett to Munger, and countless modern value investors who still whisper his name when markets turn irrational. But behind that calm intelligence was a man who had seen destruction. Benjamin Graham didn't invent discipline because it made sense. He invented it because he had no other choice. Born in 1894, Graham's early years were shaped by poverty. His family lost everything after the panic of 1907. The pain of losing his security would shape his life. He devoted his mind to ensuring that no one blindly made the same mistake. He spent years studying companies like a scientist studying cells. He dissected them, found patterns, discovered what made them truly valuable. He discovered that emotion was the virus of finance, and logic, cold, patient, data-driven logic, was the only cure. This was the birth of the margin of safety, the idea that a smart investor would never risk bankruptcy, even if he were wrong. If a stock had an intrinsic value of $100, Graham would only buy it for $70 or less. This gap, this margin, wasn't greed, it was humility, because Graham knew that even the brightest minds could be wrong. But when your ego failed, discipline could protect you from disaster. He called it the investor's shield. The essence of investment management is managing risks, not returns. The reason Graham's ideas still resonate a century later lies in these words, and therein lies the truth. The more rational you are, the more isolated you feel in the market. Crowds celebrate momentum, they worship trends. But rational investors stand out from the crowd, frequently ridiculed, frequently doubted. But over time, their composure grows. Their patience translates into profit. Their logic translates into a legacy. That's why Warren Buffett still calls Graham's Securities Analysis the best book ever written on investing. Not because it teaches you how to get rich, but because it teaches you how not to lose your mind in the pursuit. Graham's genius wasn't in predicting the market. It was in predicting human behavior. He understood that people would always overreact to both fear and greed. So he designed a system that transcended emotions, a plan for everyone, willing to think clearly when everyone else was panicking. He didn't promise certainty, he offered clarity. And in the financial world, clarity is the rarest currency. Today, we live in a world Graham could never have imagined. Algorithms, high-frequency trading, crypto speculation. But principles remain timeless, because markets change. Technology evolves, but human nature always remains the same. That's why Graham's voice still whispers through every market crash, every bubble, every boom. Be rational, be patient, be humble, value, not noise. And that's where our story begins, with a man who transformed chaos into clarity, emotion into reason, gambling into investing. This isn't just finance, this is philosophy. Benjamin Graham's philosophy, the father of rational investing. Every market cycle tells the same story. Euphoria, denial, crash, regret. New technology, new players, new promises, but the end never changes. Benjamin Graham saw this long before he bought or sold a single stock. He understood something disturbing. The market doesn't destroy people. People destroy themselves through the market. For Graham, speculation wasn't evil. It was human nature in disguise. Greed disguised as trust. Fear disguised as caution. Hope disguised as analysis. In the 1920s, he observed investors who believed every stock was a ticket to freedom and saw them destroyed in the crash of 1929. Not because they were unlucky, but because they believed that emotions could overwhelm the system. This illusion, that feeling good is the same as being right, became Graham's lifelong nemesis. So he developed a philosophy designed to combat emotion with evidence. He called it the discipline of the rational mind. The principle was simple. When everyone around you feels confident, question everything. When everyone else feels hopeless, look for value. When markets move in droves, think independently. In other words, investing is not the art of guessing, it's the science of survival. To illustrate this, Graham told his students a story about human behavior, not numbers. Imagine, he said, you own a business with a partner named Mr. Market. Every day, Mr. Market knocks on your door, offering to buy your stock or sell his. Some days, he's cheerful, offering exorbitant prices. Other days, he's unhappy, ready to sell for next to nothing. Your job is simple. You can trade with him or ignore him. But remember, his state of mind is not your value. This now legendary metaphor changed the way the world understood markets. It wasn't a system, it was a mirror. We are Mr. Market. Our excitement, our fear, our mind-boggling optimism. The brilliance of Graham's idea wasn't complexity, it was humility. He acknowledged that humans can never completely overcome emotions. Instead, he created a system that worked despite emotions, a system that allowed reason to breathe where panic suffocates. That's why Buffett later said, "You don't need to be a genius to invest well. You just need the right temperament." And that temperament, the calm, patient, skeptical mind, was Graham's true invention. But the true test of rationality came in the aftermath of the Great Depression. The market wasn't just volatile, it was psychologically broken. Every investor carried trauma. Fear became a culture. Caution turned to paralysis. Graham confronted the students who refused to believe in the markets again. He told them, "The stock market is not your enemy. Your expectations are." He taught that loss is not failure, but the price of education. In other words, he made thinking the price of learning. It is not volatility, but denial that ruins investors. Because denial blinds the mind, and reason is the investor's only compass. From this philosophy emerged his most misunderstood idea, intrinsic value. The concept was revolutionary and simple. Every business has two prices: the price the market currently assigns it, the price of its true value based on facts. The first is emotion. The second is reality. Graham's mission was to teach the world to distinguish between them. He spent decades devising formulas and methods to approximate intrinsic value, earnings power, asset backing, dividend stability, and debt ratios. But the real issue wasn't mathematics. The real issue was the discipline behind mathematics. Numbers were tools. Reasoning was a craft. Graham's mind was a paradox, logical yet profoundly human. He believed that numbers could reveal truth, but only to those who approach them with humility. He once said, "Numbers don't lie, but liars can calculate." He meant that even data, when used by the ego, could become a weapon. He encouraged investors to see balance sheets not as ornaments but as moral tests, a register of honesty or delusion. That's why his students didn't just become better investors. They became better thinkers. Every generation rediscovers this lesson the hard way. In the dot-com bubble, emotion was rebranded as innovation. In the crypto boom, it was called disruption. But beneath every wave lies the same psychology, a hunger for shortcuts. Graham's philosophy endures because it rejects shortcuts. It rewards patience, inquiry, and skepticism. It demands that you acquire faith rather than rent excitement. This isn't old-fashioned investing. It's timeless clarity. By the 1950s, Graham's lectures were attended by young minds who would one day become giants, men like Warren Buffett, Irving Kahn, and Walter Schloss. They didn't just learn valuation. They learned emotional discipline, the rarest skill in finance. Buffett once recalled, "The best thing I learned from Graham wasn't how to value stocks, but how to value myself, regardless of the market's opinion." This is the psychology of value, knowing your own worth even if the crowd disagrees. But Graham never simplified patience. He knew it was painful. He knew that being cautious while the world celebrates risk feels like a failure. He called it the loneliness of rationality. And yet, it is in this loneliness that clarity resides. Being rational is standing still while others run, not because you're slow, but because you know where you're going. This mindset has transformed ordinary investors into legends, because when everyone panics, rational thinkers inherit the future. So why, despite all his wisdom, do so few follow Graham's path? Because it's boring. The world wants excitement, not reality. It wants action, not meaning. And yet the quiet investor, the one who reads, waits, and thinks, always outlasts the loudest speculator. Graham didn't just redefine investing. He redefined success. Not winning fast, but surviving smartly. Their legacy isn't a formula, it's a philosophy, a way of thinking that transforms chaos into clarity. Yes, he gave us the tools, ratios, margins, and valuations, but he also gave us something far more powerful, a mindset immune to panic. This is the true psychology of value, not numbers but nerves, not calculation but character. And so, fear and greed, the ebb and flow, as the market continues its endless dance. Graham's voice still resonates. In the short run, the market is a voting machine. In the long run, it's a weighing machine. This simple yet profound line reminds us that truth will always resurface, no matter how deeply emotions bury it. Benjamin Graham's second gift to the world. Not just how to invest, but how to think clearly when everyone else is losing their minds. There's a reason most fortunes are lost. They're built on moments, not methods. They're built on excitement, not endurance. Benjamin Graham wasn't chasing a moment. He was designing a system that would protect ordinary people from the chaos of extraordinary times. While others searched for the next big thing, Graham sought something timeless. He believed that true wealth wasn't about predicting the future, but about weathering it. For Graham, survival hinged on a single word: structure. Markets rise and fall, trends come and go, but a solid foundation, a disciplined, logical framework, can withstand both exuberance and disaster. So he built the foundation brick by brick, transforming chaos into calculation. The first brick was margin of safety. It became the cornerstone of all value investing. The idea was simple: never buy a dollar for a dollar. Buy for 50 cents. In other words, always allow for error, because no matter how smart you think you are, the world will always surprise you. That buffer between price and value wasn't about being pessimistic, it was about being realistic. Margin of safety isn't just mathematical, it's psychological armor. Graham explained it this way: if you're building a 30-ton bridge and expect 10-ton trucks, you build it for 50-ton trucks, because uncertainty is the only certainty. He wanted investors to act like probability engineers, not gamblers. Careful, moderate, always overinvest. This principle distinguished speculation from investing, not by what you buy, but by why you buy it. Then came the second brick: the defensive and the entrepreneurial investor. Graham knew that not everyone had the same time, temperament, or risk tolerance, so he divided the investing world into two archetypes: the defensive investor, focused on protection, diversification, and stability; the entrepreneurial investor, willing to expend more effort, study, research, analysis, in exchange for higher returns. None was superior. The key was self-awareness. Know who you are and build accordingly, because destruction often begins where ego overrides reality. For the defensive investor, Graham offered a clear roadmap. Stick to large, established companies. Diversify widely. No single position should dominate your portfolio. Don't focus on timing the market. Focus on value and return. Avoid complexity you don't understand. His words anticipated what modern finance would call risk management decades before the term was popularized. For the enterprising investor, the rules have changed, but the principles haven't. Work diligently. Look where others ignore. Buy when there's blood on the streets, but only after verifying the numbers are real. He also warned about something the modern world still ignores: the illusion of activity. He said most investors confuse action with progress. They trade, adjust, tweak, and panic, believing that doing something means achieving something. But the market rewards patience, not performance. It punishes drive disguised as intelligence. In Graham's system, inaction wasn't laziness. It was mastery. He once told a student, "The investor's biggest problem, and even his biggest enemy, is probably himself." The third pillar was quantitative discipline. It was the science within the art. Graham developed formulas to identify undervalued stocks, low price-to-earnings ratios, strong balance sheets, stable dividend histories, low debt relative to assets. But he never viewed these as commandments. They were filters, not beliefs. Numbers guided judgment. They did not replace it. He warned his readers not to confuse accuracy with precision. A formula may calculate, but only judgment can decide. This is what distinguished Graham from speculators who relied on intuition or headlines. He developed systems to neutralize emotions, not to ignore them, but to control them. He once likened investing to driving through fog. You can't clear the fog, but you can slow down, turn on your lights, and know which path you're on. This was his genius, transforming uncertainty from a threat into a guide. By the mid-20th century, Graham's framework had become a quiet revolution. His students weren't chasing trends, they were analyzing businesses, reading financial statements like detectives, and viewing money as a tool, not an identity. They weren't building portfolios, they were building philosophies. And over time, these philosophies built empires. From Buffett's Berkshire Hathaway to the countless funds preaching value today, each carries Graham's blueprint in its DNA. But the irony is this. While Graham invented the architecture of modern investing, he never sought wealth for himself. He lived a modest life, often more like a teacher than a businessman. For him, wealth was measured not in dollars, but in discipline. He once said, "Money always follows intelligence, but intelligence rarely follows money." For Graham, knowledge was not a ladder to status. It was a shield against ignorance. This humility became his quiet strength. In his later years, Graham reflected on the irony of his legacy. He had built a system that could make anyone rich, but he believed its greatest asset was peace of mind. For him, financial independence wasn't the freedom to buy more, but the freedom from fear. He wanted people to invest not just their money, but their character, because without character, even a perfect formula collapses. As markets evolve, from ticker tape to algorithms, from Wall Street floors to digital screens, the principles remain the same. Margin of safety, discipline, rationality, humility. Each generation believes it is smarter than the last. But, as Graham would say, the truth is, the market always finds new ways to test old wisdom, and those who forget architecture will always rebuild the ruins. So, value architecture is not just a method, it's a mindset. A fortress built on restraint, logic, and patience. It doesn't promise excitement, it promises endurance. Benjamin Graham didn't teach people how to make money, he taught them how to protect it. Because in the long-term game of markets, the winners are not those who rise the fastest, but those who hold on the longest. This is the true architecture of wealth. Not speed, not luck, but structure. When history breaks, it doesn't scream. It whispers. Fortunes collapse silently, not in the panic of a single day, but in the comfort of many easy days. Benjamin Graham knew this all too well. He lived through the Roaring '20s, a decade when everyone believed the sky was the limit, when reason replaced rhythm, and the stock market felt like a never-ending party, until it did. 1929 wasn't just a crash, it was a revelation. It revealed how fragile genius blinded by self-confidence can be. Men who thought they had mastered the market found themselves ruined. Banks collapsed. Families were plunged into poverty. And the air, once filled with laughter and champagne, was now heavy with silence and disbelief. Graham watched it all unfold, not from the sidelines, but from within the rubble. He lost nearly 70% of his own fortune. The same man who had scrutinized numbers with surgical precision was now studying the anatomy of collapse. But where others saw failure, Graham saw a lesson. He realized that ignorance wasn't a lack of knowledge, but a denial of it. It was the investor who said, "This time is different." It was the banker who said, "The numbers don't matter anymore." It was the crowd who whispered, "Everyone's getting rich, don't miss out." And so the empire of reason collapsed not from war, not from weakness, but from the illusion of invincibility. From this devastation, Graham drew one of finance's harshest truths. In the short term, the market is a voting machine. In the long term, a weighing machine. This was his way of saying that popularity doesn't mean permanence. A stock may be loved today and forgotten tomorrow, but value, true value, endures. It became the dividing line between the intelligent and the reckless. between those who see the market as a mirror and those who see it as a microscope. The speculator wants to be admired. The investor wants to understand. To illustrate this point, Graham often reminded his students of his most famous metaphor, the story of Mr. Market. Imagine, he said, you own a small business with a partner named Mr. Market. Mr. Market knocks on your door every day, offering to buy your stock or sell you his. Sometimes he's enthusiastic. He offers absurdly high prices. Other times he's depressed. He offers to sell at a very low price. You can either accept him or ignore him. A lesson? Mr. Market's emotions are your opportunity, not your guide. The metaphor was brilliant because it made the abstract feel human. The market wasn't a machine. It was a mind, irrational, impulsive, pessimistic, and if you let that mind control you, you will ultimately destroy yourself. In Graham's words, the greatest advantage of an investor is the ability to be patient while others are emotional. He didn't teach people to beat the market. He taught them to go beyond it. This distinction separated the thinkers from the followers. But despite this wisdom, Graham knew that time erodes discipline. The more stable markets become, the more careless investors become. Security breeds complacency. After each crisis, he observed how a new generation rose, confident, intelligent, and utterly convinced they were smarter than the last. They built their own empires of optimism on new technologies, new theories, new jargon, but always on the same old ignorance. Graham's students called this the cycle of forgetting. It begins with success. Success breeds overconfidence. Overconfidence breeds speculation. Speculation breeds collapse. And when the dust settles, wisdom returns, wounded but intact. He once said, "Those who cannot remember their mistakes are condemned to repeat them, in new forms, under new names." Every bubble, tulips, railroads, dot-coms, cryptocurrencies, was nothing but a costume change of the same ancient game. Graham wasn't a cynic. He was an observer. He viewed human behavior as a kind of economic gravitational force, perpetually pulling the mind toward greed. But he believed this gravitational force could be countered through education. Not classroom education, but self-education. For him, every investor was also a philosopher. You had to study not only the market, but also yourself within it. So, his books were less like textbooks and more like meditations on human behavior. When Graham lectured, he would often pause mid-sentence as if weighing every word. Students described these pauses as the sound of thinking. Graham would ask, "What is risk?" Most would reply, "Losing money," but Graham would smile and say, "No. Risk is not knowing what you're doing. It's not volatility that destroys wealth, but ignorance." This single insight distinguished the serious from the foolish. By the 1950s, his lectures had become legendary. Future billionaires sat in his classroom, taking notes while shattering the illusions of Wall Street. But he wasn't teaching them to get rich. He was teaching them to be rational. And rationality, he said, was not natural. It was something acquired through discipline, humility, and doubt. Always question your conclusions, he would remind them. Self-confidence is the mask worn by ignorance. Decades later, when a new generation repeated the same mistakes, Graham's words resonated louder than ever. The tech bubble, the housing crash, the meme stock craze, different names, same psychology. He would watch these frenzies unfold with both amusement and sadness, because despite all our progress, we still haven't overcome ourselves. And perhaps this was the tragedy he foresaw, that intelligence will advance faster than wisdom. But if ignorance can destroy empires, awareness can rebuild them. Graham's message, in its purest form, was this: investing wasn't about guessing, it was about preparation. It wasn't about finding certainty, but about managing uncertainty. He believed that success in the market, like success in life, is not a race to be won, but a craft to be mastered. And mastery begins where ignorance ends, with understanding. So, when you look at the great collapses of history, don't see chaos. See the lessons etched in time. Every empire, every fortune, every collapse is a mirror. Graham left us the language to read these reflections, a way to transform loss into logic, emotion into resilience, and ignorance into insight. Because, as he once wrote, the purpose of financial markets is not to make you rich. It is to test your character. And for those who learn this lesson, the collapse of empires is not the end. It is an education. There is a moment, often invisible, when chaos meets control. A turning point when the noise of speculation subsides and the silence of thought begins to speak. Graham believed that this moment was the birth of true investing. He viewed markets not as battles to be won, but as puzzles to be solved. And the tool to solve them wasn't genius, it was logic. Logic, not emotion, was the investor's superpower. While the crowd sought excitement, Graham studied balance. He had grasped a timeless truth. The enemy in finance isn't volatility, but vulnerability. Vulnerability to greed, envy, the seductive illusion of you're smarter than everyone else. And so he established a discipline of thought, a framework within which rationality governed emotion and patience conquered pride. This discipline didn't come from numbers alone. It came from philosophy. Graham was deeply influenced by the Stoics, Epictetus, Marcus Aurelius, Seneca, who taught that reason is the only freedom. He saw investing as an extension of the Stoic virtues, controlling what you can control, accepting what you cannot control, and thinking clearly amidst chaos. Markets, he once said, are the arenas where human nature is on display, and our only defense is reason. Graham often compared investors to sailors. The vast, unpredictable, merciless sea was the market, and reason was the compass. A sailor cannot calm the sea, but he can skillfully steer it. Similarly, an investor cannot control the market, but he can control himself. This control, this discipline, was the foundation of what he called smart investing, not brilliant investing, not aggressive investing, just smart, a quiet, steady, almost modest word. He defined the smart investor as one who buys not because he hopes for a quick profit, but because he knows what he owns and why. This was a subtle revolution in thinking. Before Graham, Wall Street worshipped speculation. After him, it began to respect analysis. The shift from hype to evidence was the birth of modern value investing. Yet, Graham's genius wasn't just analytical, it was psychological. He questioned not only what makes a good investment, but also what makes a rational investor. He recognized patterns in human behavior, how fear and greed operate in cycles, how confidence follows success and precedes failure. He saw the same people making the same mistakes over and over again, not from a lack of data, but from a lack of discipline. This led him to a profound truth. The most dangerous force in the markets is not risk, but emotion. That's why he encouraged investors to build a margin of safety, not just in numbers, but also in temperament. One of his most powerful ideas, margin of safety, meant leaving a margin of error. If you buy a business for less than its value, you're protecting yourself against your own margin of error, because being human means being wrong often. Graham understood this better than anyone. He never preached perfection. He preached conservation. The investor's greatest enemy is not the market, but the mirror, he used to say. The first thing his students had to confront was that mirror, our reflection, our pride, our fear. For him, investing was an act of self-awareness. When you analyze a stock, you also analyze yourself, your patience, your self-confidence, your biases. It's not a war against others, but a war against your own impulses. That's why his teachings resonate even decades later, because the market changes, but human nature doesn't. Every generation believes it's different. Every bubble says, this time is new. But the same emotions, greed, fear, pride, continue their endless rhythm. And yet, within that rhythm lies opportunity. for those who can think when others react. Graham didn't predict the future. He prepared for it. He built his portfolios like fortresses, strong not because they were perfect, but because they were prepared for imperfection. He believed that rationality was a moral choice, not an advantage to be exploited, but a duty to be protected. Because thinking clearly in a noisy world is an act of courage. As Graham reached old age, he became more of a philosopher than a financier. He no longer talked about profits, but about principles. He reminded his students that money was a means, not an end. Wealth without wisdom is a form of poverty. He said, if you can't define what you're doing as investing, it's speculation, and speculation is the opposite of discipline. His listeners didn't always understand. They came for formulas. He gave them frameworks. One of his favorite exercises was deceptively simple. He would write 2 words on the board, price and value. Then he would turn to the class and ask, "What's the difference?" Silence. Then, softly, he would reply, "Everything." That silence, that gap between price and value, was the essence of investing, because markets measure popularity. But value measures permanence. He taught that investing wasn't about guessing what others would think, but about understanding how valuable something really is. This required independence of thought, a willingness to stand alone, to be right long before others realize it. Graham warned that such thinking was lonely but necessary. The crowd, he said, is often wrong but never doubts. He viewed logic not as cold-blooded calculation, but as an emotional discipline. The ability to remain calm when others panic, to remain humble when others boast. He would tell his students, "You don't need to be clever. You just need to be level-headed." This is the essence of rational investing. Not intelligence, but integrity. And that's why his legacy endures. He taught people not how to get rich quick, but how to remain rational forever. Decades have passed since Benjamin Graham's time, but the battle between reason and emotion rages on. In every clash, in every explosion, you can still hear his voice, calm, analytical, unwavering. He gave the world more than methods. It gave him a mindset. Because after all, the true superpower isn't foresight. It's perception, consistency, not speed, logic, not luck. If you found wisdom in this story, don't miss what comes next. How Benjamin Graham revealed the hidden psychology behind market illusions.